morning, and thank you for joining us today. I'm Olivia Rios, Director of Operations and Programs at the LA Latino Chamber, and we're excited to have a program specifically for businesses. Today's topic is managing business financials and is being presented by U.S. Bank. Key takeaways are you will learn how to track your money, understand the role of balance sheets, and understand your financial statements. These are very critical for daily operations, for if you don't know where your business stands financially, it can be detrimental. And at one point, if you are seeking capital, it'd be difficult to obtain lines of credit or even loans. With us today are two banking experts. Our first speaker is Liz DeBroy, Business Access Advisor, and Eddie Reyes, Vice President, Relationship Manager, both with U.S. Bank, and together they have over 30 years of banking experience. Before we start, we ask you mute yourselves, ask questions in the chat, and the session is being recorded and will be available on our website within 48 hours. After our session, Mayra Braga from Delta Airlines will share the great things that are happening at Delta Airlines. And with that, I'd like to welcome Liz and Eddie.
I am the Business Access Advisor, as Olivia mentioned, for U.S. Bank. I have been with U.S. Bank for 12 years, and I'm really excited to lead this call today. I hope that I'm able to provide you more insight on how to manage your financials, how to be loan ready when you are ready to apply for funding. And with us today, we have Eddie Reyes, who is our expert. We do ask you to please engage in asking questions on the chat. We're going to go ahead and go through our questions, and hopefully we're able to provide answers for all of you today. There's no such thing as a question that you shouldn't ask. So please, I encourage you to ask whatever comes to mind, and we hope to provide you answers. And Eddie, thank you for joining us. I think I already introduced you, so we can go ahead and get started. So our agenda for today is we're going to review the benefits of proper financial management. We're going to discuss an overview of business financial statements, and later we will explore the critical role of a balance sheet and how to use it to help you track your money. So let's get started with tracking your money. So we're going to list some of the benefits of financial management and a high-level overview of financial statements. So how does your business make money? How does your business grow? What does your business have to set up to expand and diversify? And will these questions answer how can your business prepare for financing? In this section, we want you to emphasize some of the benefits of financial management. By properly tracking your money, you can reach your goals by making good decisions. Here are some of the key benefits to healthy financial management and some questions to think about along the way. Know your value. Generating financial data will allow you to identify your assets, liability, and equity at any given moment. This will help you understand your profit margins and allow you to manage your business more efficiently. Forecast your growth. How long do you think it will take your company to grow? Tracking your financials allows you to plan for diversification, new product lines, and how to reach the new markets. Prepare for financing. This is how you prepare for your loan. Do you have the proper funding, or do you need additional financing to achieve your goals? Maintaining proper bookkeeping practices will help you identify potential obstacles and growth opportunities. Let's continue with bookkeeping basics. As a business owner moves through the business process, there are ways to make your business more efficient and profitable. Generating financial statements as a tool will help you see the opportunities as well as the gaps you have in making your business profitable. Remember to track the finances going into and out of your business on a routinely basis. It is good to seek the aid of software and a professional bookkeeper or a CPA to assist you, but ultimately, the responsibility comes down to the business owner to ensure that you're tracking everything and making your business grow. Here are some key money tracking tasks that all businesses need to continually administrate. You need to ensure that you're reconciling your accounts, make and track your sales, deposit sales into a business account, and this I want to emphasize on. Ensure that you're separating your business and personal accounts. Pay expenses from business accounts, generate financial statements, and make sure that you're also paying yourself with an owner's draw if it's applicable. Let's continue to financial statements. Financial reports tell you what the health of your business is. There are three basic statements that provide different views of a company's performance. They are useful tools for analyzing a company's value and often a requirement for obtaining any additional financing for business that is already established. Cash flow projections. This is going to estimate the money you expect to flow in and out of your business, including all of your income and your expenses. Most business cash flow projections cover a 12-month period. Your business can create a weekly, monthly, or semi annual projection. Next is a profit and loss statement. A profit and loss statement is a financial statement of a company, and it shows a company's revenues and expenses during a particular period. It indicates how the revenues are transformed into the net income or net profit. And finally, our balance sheet. This is a financial statement that reports a company's assets, liabilities, and shareholder equity. This is a view of how your business looks at a point in time. Working with balance sheets. In this section, we will take a deeper dive into the role of balance sheet and how to use it to help you track your money. If you are working with a supplier or a customer on an ongoing basis, you may want to see their balance sheet. This is going to give you an indication of whether they will have the ability to pay you or whether they will be able to supply the inventory that you need in the future. You may also be asked for your balance sheet or other financials if you are engaging with a partner like a supplier or a financial institution. They will want to see if you are profitable and if you are able to meet your debts. Let's continue with financial statement basics. The balance sheet represents a point in time, and you can select a specific date when generating your report. Balance sheets use generally accepted accounting principles. We also refer to this as GAAP. The GAAP governs how assets, liabilities, and equity are reported for accuracy and uniform reporting. If you are working with an accountant, you will want to understand the difference between what is reported to the IRS and what is used for business management. The IRS has certain rules that are different than those used by GAAP and lead to different numbers being reported on tax returns. The IRS looks closely at depreciation, amortization, meals, and entertainment for tax estimating. Let's continue to fundamental accounting equation. Let's take a closer look at the common components of a balance sheet at a high level. The balance sheet gets its name because everything on the sheet must balance out. You can see the equation of assets equals liabilities plus equity on the chart. This is the underlying rationale for all aspects of accounting and demonstrates the value of your company. Assets are what a business owns. This can be either tangible assets like your cash, your property, or equipment. It can also include intangible assets like copyrights, patents, and trademarks. Liabilities are the debts that the business has. This can be in the form of outstanding loans or accounts payable. Equity is often referred to as the net worth. It is the difference between what is owed and what is owned and what is owed. Another way to think about the assets is what you actually have minus your liabilities. So what you actually owe. So what you have versus what you owe. That's going to equal the equity. So what your company is actually worth. Let's continue and review a sample balance sheet. This is what a balance sheet looks like. You can see some of the components we talked about. The assets on the left include cash, land, and equipment. It is ordered by the most liquid assets at the top with the least liquid assets at the bottom. Note the blue gradient colors from top to bottom. We will go into more details on the asset types shortly. The total on the example is $472,100. The right side begins with the current liabilities. It lists accounts payables and other debts. It is written so that you can see the items due sooner at the top with longer term debt below. The final section is your owner's equity. This includes the money the business owner or owners have invested into the company as well as retained earnings. Retained earnings is the money the company has left over after meeting all of its other debt, taxes, and any shareholder dividends. Notice that the right and the left side totals are equal and highlighted with a star. They must always match up. The retained earnings is what the company is using to grow. It can be used in the future for investments. If you look through the balance sheet, you can find ways to improve your assets or decrease costs. We will dive into that on the next few slides. And Olivia, I'm going to pause right there and see if we have any questions on our chat box.
We do have a question. Patricia Perez is asking, what business tracking software do you recommend?
So, Eddie, I would love if you can chime in on this one, but I know that the most popular is QuickBooks that business owners tend to use.
A lot of the banks are compatible with QuickBooks, so it makes it very easy to just download information back and forth. Yeah, I would probably say QuickBooks is probably there's some other ones out there as well. More than happy to give you some recommendations, but I think QuickBooks is probably the one that everybody uses, and it's really easy to use. And then if I could just make a quick note on this balance sheet, I know you're going to dive into it a little bit deeper as well, Elizabeth, but when banks look at a balance sheet, it's probably one of the most important documents that banks look at when you're applying for a loan with the bank. Okay. One of the things to kind of keep an eye out is you wouldn't believe how many times I've looked at like a balance sheet where it doesn't balance, right? So just make sure, if you're ever looking at some type of financial request from a bank, make sure those two bottom numbers do balance out. And it's accurate, right? A lot of the information in there is accurate as possible. But this really gives the bank a good snapshot of your business and the health of your business. And we can tell a lot just by this document here. Okay. So having a good understanding of kind of where a lot of these numbers come from and what they are, and, just be able to kind of explain to a banker is always a great thing. But I know, Elizabeth, you're going to talk more in detail about them. So I'll transfer back to you.
Awesome. Thank you. So we can go ahead and jump right into analyze current assets. So when looking at the assets of the business, you can review where you're holding the company value. We will first look at the current assets. These are the assets that can be converted into cash within 12 months. Note that the gradient colors align with the previous slide. The darker colors indicate assets that are more liquid and readily available compared to the lighter colors on the right. In conjunction with other financial sheets, you can decide if you have enough cash on hand to meet expenses. You can also look at how large your receivables are. This could point out where you have customers that need to pay you or are late on payments. Additionally, you can see how much inventory you have on hand and whether that makes sense for your business. This will allow you to adjust up or down depending on the needs of the business. You will want to get a sense of what you have in cash, and the line items that can quickly be converted into cash should be unforeseen expenses arise. Assets listed in the order from left to right, which they should be more readily converted to cash. So if I want to make sure, does everyone understand the different types of long-term assets that are shown on here? And if you don't, I can get into a little bit more detail if you ask on the chat box. And Olivia, you're free to chime in, and I can define any of these for you if need be.
What about if you go over account receivables real quickly?
Mm-hmm.
Yeah. So the accounts receivable, this is monies owed to the business as a result of the sale of their products or services. This account may or may not show the supporting detail of the expected bad debt. So if reported as net ARs, the business is showing the number after the expected bad debts are written off. Regardless, you should ask about their collection practice as well as their bad debt experience.
One more question. What is cash equivalent?
So cash equivalent, some businesses will invest extra cash in a highly liquid investments, which can be readily converted into cash. They include marketable securities, money market funds, treasury bills, and commercial paper.
Would you consider a CD cash equivalent? Since you'll put in X amount, but if you really need to, you'd pull it out and be able to access it, even though you wouldn't want to, because you're earning interest on it. But sometimes there's those emergencies that you do need to pull it out.
Yes, I would consider that as like a marketable security. If need be, yes, it's a cash equivalent.
Okay, thank you.
That's actually really, really big. Just having a good understanding of your accounts receivable and what that is made up of is really important, right? So Typically most banks look at accounts receivable that are due within 90 days, right? Anything other than 90 days is probably something the bank might not want to lend on. I don't want to speak to all the banks' different policies, but that's just a good, general rule of thumb, if you will, as well. And then having a good understanding of whether it's a domestic receivable, a foreign receivable. You could really break that down, right? As well. So, and who are those receivables from, right? As well, the actual companies that are lending to you. So the banks do they do a really big deep dive on this account receivable portion for sure. So if you're ever working with the bank, expect to get a lot of questions around this piece as well. So let's back to you.
Yeah, no, thank you. Thank you for covering that. So let's go ahead into analyzing long-term assets. So let's compare our long-term assets. These assets take longer than 12 months to turn into cash. These assets are also generally lose value. They will lose value over time. As you use your furniture or equipment, it becomes less valuable due to the wear and tear that the business puts on the asset. They still have value. For example, a business vehicle, which could be in the equipment category, can still be sold for cash, but will generally be worth less than what it was the day that you purchased it. It now has miles, worn out tires, and paint chips. We recognize that these items lose values and categorize them as depletion and amortization. So long-term assets are listed in the order in which they should be used left to right. Note that these are a continuation from the previous slide, with the darker assets indicating more liquidity on the left. Depreciation is used to report the diminishment of value of a tangible asset, such as furniture, fixtures, equipment, or buildings. Because these assets lose value over time, they are depreciated. Land is assumed normally not to lose its value. That is why it is often separately listed on a balance sheet. If the property has natural resources, such as oil, which are being extracted, this asset account will reflect on depletion. Intangible assets are amortized rather than depreciated. Amortization reflects the diminishment of value of intangible assets, such as trademarks, copyrights, patents, to not compete, and goodwill. For example, since patents will expire and goodwill is only as good as the last interaction, those assets will diminish in value over time. It becomes less valuable to sell your patent if it expires soon. Understanding the value of your assets and the impact that they will have over time will help you better prepare for expenses and can help you determine if you want to sell an asset like an equipment, building, or your land. I just want to cover depreciation. So for furniture and fixtures, furniture and fixtures are assets that would be movable and include things such as like your desks, chairs, bookcases. Equipment would include all of your assets used in business operations, like your computers, manufacturing equipment, your trucks would be included in this category. And then obviously, as well as your buildings. So most commercial buildings lose value over time due to use and costly upkeep. Under the depletion for land, that reports the estimated reduction of value as natural resources are removed from the land. So another example is when the trees are cut down with a barrel of oil is pumped out of the ground, the field is depleted. And then amortization reflects the diminishment of value of an intangible asset, such as a patent or a goodwill. So your trademarks, copyrights, and patents indicate a legally recognized protection, subject to certain limitations and challenges for a name, a slogan, or an intellectual creation. So businesses are limited to reporting the costs associated with these assets. And we can go ahead and continue to analyzing current liabilities.
For equipment, there is some bonus depreciation for that. So just be mindful of that. The government allows some tax write-offs on that part of it. But there is some benefits to buying equipment, and the government definitely encourages it. So talk to your CPA, talk to your banker. If you have equipment that maybe you've been putting off for, but you need to replace, that includes for furniture and fixtures and a bunch of other stuff. So definitely keep that into mind as you're thinking about you're planning for the future.
So now let's take a look at the liabilities. As with assets, there are current and long-term liabilities. The current liabilities are debts that need to be paid from cash within 12 months. These are debts that will most likely have to come out of current assets category in the near term. When analyzing a balance sheet, you will want to determine that your current assets can cover the current liabilities. If not, you will want to implement a plan to meet your current obligations. If not, your supplier may not provide materials for you in the future. So let's take a moment to review each of the key types of current liabilities. So your accounts payables reflects purchases from suppliers on credit. Typically, they are paid within 30 days. Examples may be raw materials or finished goods inventory. Notes payable list any short-term obligations of the business. So lines of credit are often included in this category. Accrued expenses reflect any obligations that have been created but not yet paid. Common examples are salaries, utility bills, interest expense, and taxes. And your long-term debt lists the minimum payments that will be due on outstanding loans over the next 12 months. Here's a quick tip. If you're having difficulty making payments, have a conversation with your supplier or your bank. Don't just skip the payment. There's different resources that your bank will be able to provide to you in order to keep up with your payments, even a small line of credit. Many banks offer these, as well as possibly even utilizing your business credit card to make up for those payments. So just a quick tip there before we move over to managing long-term liabilities. So long-term liabilities are debts scheduled to be paid over a longer period. When looking to borrow additional capital for your business, the bank will often look at your outstanding long-term debts to see whether there is enough in the assets to cover the payments needed for longer-term debt. Remember that the current 12 months of payment for loans are considered part of the current liabilities, but the balance of the loan is part of your long-term liabilities for the company. So we're going to take a quick look at some of the long-term liabilities. Term loans reflect the principal balances owing on any loans with maturity greater than 12 months. Many times, commercial real estate loans are listed separately. Loans from shareholders report money put into the business by the owners as a loan rather than a stock purchase. Banks often request the owner subordinate this debt, which means the owner agrees to not pay themselves back until they pay the bank back. Here's a quick tip. Generally pay your term loan first and loans to shareholders last. The last component of the balance sheet is the equity. I think this is the fun part. Some of the components of equity are for larger companies like stock issuance, additional paid-in capital, and treasury stock. For a small business, the key components include owner's investment and retained earnings. The retained earnings are money that can be used in the future to invest in the company. Common stock represents monies put into the company in return for an ownership position. The value reported for common stock is the face or par value shown on the stock certificate. Sometimes people pay more than the par value for stock in company. The extra they paid is reported in additional paid in capital. Treasury stock is reported as an account when a business has bought back some of their issued stock. It is a reduction in equity. Owner's investment is the amount of personal money that the owner or owners have provided to the company. The income statement connects to the balance sheet through the retained earnings account. When an accounting period is closed and after any dividends or distributions are deducted, the total of profits or losses earned in the period are added to the retained earnings. As stated before, one way to calculate equity is to subtract liabilities from its assets. Equity tells you the value of your business. So let's continue on the last takeaway. Since a balance sheet is a point in time, it is valuable to compare one time period against one last takeaway. Since a balance sheet is a point in time, it is valuable to compare one time period against another to see the trajectory of different line items. This is called common sizing. Since assets or liabilities may be larger in one year than another, common sizing lets us see which categories increase and decrease over time. In this case, we can convert each of the items to a percent of all assets. This example is just a snapshot of the current assets section. In the first year, current assets make up 41% of total assets, but in the second year, they make up 42% of total assets. So while the absolute dollar amount of the assets is lower in the second year, you can see that more of it is it's in its current assets. The individual line items tell you that you had lower deferred taxes in the second year. By looking at your business this way, you can decide which areas you need to improve on. This is also a good way to compare yourself to other business in the industries. You can see where your business is on different line items compared to an industry standard. By converting dollars into percentages, you can compare finances over time or against the industry average. So let's continue with reviewing a balance sheet. Now that we have reviewed the terms on a balance sheet, let's take a closer look at the balance sheet from earlier. We learned that assets are more liquid, your property and equipment is less liquid. Your liabilities are due sooner, and your long term debt is due later. And your equity is the value of your company after all of the liabilities have been subtracted from your assets.
Okay, where can business find update industry on averages?
A lot of bankers use something called first research. So it gives you good insight on really just, how you compare with your peers. I'm sure Yahoo probably has Yahoo Chat or Wahoo or one of those, or you go quick Google search, you could probably find that information as well. Your banker could also tell you, right? So if you have a good conversation with your banker, you can kind of give you an idea of how you compare with other peers as well. But that's information is pretty readily available. It's out there. So you can do a quick chat, or like bankers have a system, like I said, called First Research, where it's pretty easy to pull that information.
Alrighty, and then there's another question. What is common sizing?
Common sizing is just comparing your business to another business in the industry, or maybe comparing this year to last year's expenses and assets.
Yeah, and banks also, when I was talking about the balance sheet as well last year, that's another thing to really keep an eye out for, right? And maybe you don't even need the percentage, but just seeing the year over year, growth, or if there's a drop, if you go from, I don't know, 85,000 one year in cash and another 200,000, which is a good problem to have, right? But anytime there's a change like that, banks want to know what's driving that, right? Maybe it's your inventory. So from 2002, you're holding 400,000 in inventory, and then in 2023 you're holding $600,000 in inventory, and your sales hasn't gone up. So maybe you're holding on to inventory that's not selling, right? So there's a lot of I don't think the number is as important as just knowing when there's a jump from year to year. And being able to explain that and have a story behind it, especially when working with a banker.
Yeah, great questions. Today, I just want to say thank you for attending our Managing Business Financials course with the Los Angeles Latino Chamber and in partnership with US Bank. Just a few key points to remember. Financial reporting and tracking your money through financial statements can prepare or make your help you make a sound business decision. The role of the balance sheet can help you track your money and provide a snapshot of your assets, liabilities, and equity at a given time. Also, utilizing accounting software, a bookkeeper, or a CPA can be valuable, but ultimately, the business owner needs to understand their own financial position. And also, separating your business accounts from personal will make it easier to see the financial health of your business. I want to say thank you to everybody that joined us today. And please feel free to look at our financial resources page at US Bank. You can use a QR code if you'd like to bookmark the page, or if you want to go ahead and reach out to us to schedule an appointment. Thank you, Olivia, for having us on.
Well, thank you, Liz and Eddie, for your presentation. And now we'll head over to Maida Braga, who is joining us with Delta Airlines, and she'll be sharing some of the special perks that you can receive as a small to medium-sized business.
Thank you so much, Olivia. Good morning, everyone. It was a great webinar. I learned so much. As Delta Airlines, we are one of the proud sponsors of the LA Latino Chamber of Commerce. And hopefully with all these educations webinar, you guys are able to grow your business and then take some flights to any place that Delta flies. We are the largest carrier in the United States. We have a very robust domestic network. Some of our hubs in US are Los Angeles, Salt Lake City, Seattle, Atlanta, Minneapolis, Boston, LaGuardia, New York. And we also fly globally to every continent, not just Delta, but in partnership with other airlines that are part of the SkyTeam, such as Aeromexico, Air France, KLM, Korean Air. So any place that you can think about, we can take you. And if we don't have a domestic flight, you can also get a private jet with Delta Airlines. So Delta has a partnership with a company called Wheels Up that they provide private jets around the world. So if you think something that you may have a need, take advantage, reach out to me to get a code, and then we can provide the service for your private jet. I also would like to reinforce once again our Sky Miles program. So this is a loyalty program that I definitely encourage every single one of you to become members. Every time that you fly with Delta or our partners or our non-travel partners such as Starbucks, Lyft, Marriott, and many others, you can accumulate miles and then you can use those miles to redeem in travel awards, in upgrades, in access to VIP lounges, and many other perks. This is free. There is no requirement to join. So take advantage, scan the QR code and make sure that you are part of Sky Miles member. And for your business, we also have a solution, pretty similar concept. It's a loyalty program that every time that you or your team members fly with Delta and our partners, the company get miles. And with those miles, you can redeem also in different travel perks. There is also no cost to participate. In order to accumulate miles, your company does need to have at least a 5,000 annual spend with us. There is no cost to participate in the program as well, and the miles never expire. So make sure that if you have a business, you sign up for the Sky Miles for Business program. I will share my information in the chat and information about the programs as well. So feel free to reach out to me to any questions that you might have about those programs and how Delta can support your travel needs. Or even if you want any tips about traveling, I'm happy to chat with you. Thank you, everyone. I hope you have a great week. Thank you, Olivia, again for your partnership. I appreciate it.
Thank you, Maida, for your partnership and that with Delta Airlines. And Delta Airlines is the official airline of the LA Latino Chamber. So we're grateful for their support and helping bring these types of programs to the forefront, specifically to help small businesses. And we wish you a happy Tuesday. Goodbye.